G'day, fools. I'm Scott Phillips, and welcome to another in our Motley Fool Stocks in Focus feature video series where we bring you the companies that you mostly own, the companies that are the most widely held, the most talked about businesses on the ASX. The Motley Fool, we're in the investment advice business. You want to know what we think about those companies. Some are recommendations, some aren't. Today, I'm joined by Trevor Muchedzi, and we're going to talk about the telco to beat all telcos, mate. Probably the widest held company on the ASX, I would assume, by retail investors. Maybe the banks win. I'm not sure. The company, of course, we're talking about is Telstra. Now, mate, you haven't been around for the whole sordid tale of the good old days of telecom and Telstra and that whole story. And I won't go into it in a lot of detail because for some people it's a bad dream, for others it's a living nightmare. This was the business that was floated. I want to say one of the tranches when it was privatized. It's over $7 in 1999. Now, not only was that a long time ago, I was around for that, but it was also at the height of the dot-com mania. Think about a price of $7 for Telstra. Man, we talk about the Myers and the Dick Smiths and the bad IPOs that never quite got back to their previous highs. This is one that really has spent, 22 years struggling to get somewhere close to its listing price. Maybe if you include dividends and you're generous, maybe investors have been made whole by now. But man, it's been a long time to wait. Now, of course, that was then, and we can't go back in time. And if we could, I assume none of us would buy Telstra, but that's not the question we're here to answer, Trevor, because all we can buy or sell are the shares today. And then all we can get from here is the future returns, not the past. So Telstra's story, it's a big one, it's a long one. I should disclose very quickly, quick aside, I own Telstra shares. I own them even though my service, Motley Fool Share Advisor, recommended we sell them because they're an active recommendation in another service I run, which is purely for income. So I get asked that a lot. You know, I say to people, well, I don't own Telstra, or I do own it, but I haven't recommended it, for example. And they say, well, hang on, what? How does that work? That's the answer. So let's get that all the way out of the way. Trevor, you are here as our Telstra guru. Let's go into the category a bit, mate. This is lots going on. NBN, mobile, fixed wireless, landlines, a consolidating category, national broadband network, kind of, reseller arrangements. It's not just one of those most exciting categories sometimes. Cables and towers don't exactly turn a lot of people on, but it is one of the most widely held companies. And it's one that I'm sure our viewers would love to have a view on. So tell me, give me the current scenario for Telstra. Where are they? Where's the company at? What does the competition look like? What are the category dynamics? How should we think about Telstra?
Thank you, Scott. I think you have, you stated up correctly. I mean, Telstra essentially is not a growth company. It's like you said, it's definitely a dividend play, right? And at the moment, the company has got a target dividend of paying 16 cents per share, which is almost like enshrined in the company's DNA.
So everything at their peril, exactly.
Yep. Exactly. Everything that they do every single year is to maintain that 16 cents per share dividend. And for them to do that, they need to make about 7.5 to 8 billion in terms of operating profit. But we'll get into that a little bit later on. Okay. Today, right, Telstra is essentially made up, probably I can say, with 4 business segments. The first business segment is your personal and small business division. Essentially, right. That's your mobile phone plans, your fiber to the home internet connection. That business constitute probably something slightly above, probably I think something very, very close to more than 50% of the total revenue. But right. If you look at over the past 5 or so years, that business has been facing a lot of headwinds, and specifically because there's been so much competition in the mobile market, and the average revenue per user has been declining consistently year after year. So that business has been facing so much pressure both from a revenue and also from a margin standpoint. The second business unit is what they call the Telstra Enterprise, which is essentially providing connectivity solutions to large enterprises and the government. So a good example is the Department of Education in New South Wales can say we want to connect 1,000 schools to the Wi-Fi, to the fiber, and then they can offer that contract to Telstra for them to do that. And then the third business, which was really spun out in their T22 strategy that was unveiled in 2008, is what you call Telstra Infraco. Essentially, what they did there is that they took the hardcore infrastructure assets and then housed them into a separate business unit. We have seen this strategy being played, especially in Europe and also in North America. So Telstra has been replicating this playbook. And the thinking there is that the assets on their own, if they are under Telstra, they are typically underutilized. So for example, if Telstra owns a tower, they can put one antenna on that tower, which they own and operate. But that's massively underutilizing that asset, because there is a business case that you can rent some of that capacity and you can allow other telco operators, to put on their antennas on your tower, and then they pay you a fee. So the point of removing these assets and placing them into a separate business was to enable Telstra to monetize that asset base. So that's the third business unit. And then the fourth one, which I simply call other businesses, includes the Telstra Health Initiative. It also includes Telstra Ventures, and then it also includes their Telstra Global Business Services, essentially the undersea cables that connects Australia to other countries. But in a nutshell, those are the four business divisions or segments within the company at the moment.
That's a fascinating summary, mate. It's a really, really solid one. Thank you. If I reflect on a couple of those, I think back in the day, way back in the day, so we did recommend it at Share Advisor. I got that one horribly wrong, by the way. I'm happy to, not happy that it happened, but I think it's important to say it out loud, just for my own edification, my own reminder not to screw that up again. The old school landline business were making margins of 60, 65%, and mobiles had margins of 25 and 30%. And as traffic moved to that was always going to be a struggle. And then, as you say, the problem with telcos, and I don't envy Telstra here, same for everybody, of course, is that as data becomes more prevalent, more available at lower cost, I can either get more data for the same price, and in theory, Telstra needs more infrastructure to do that, or I can have less data, I have same data for a lower price. And again, while Telstra doesn't have to have any extra infrastructure, they've got to drop their prices. It's a really, really tough business to be in. I will also mention that the Infraco business, or infrastructure company, to kind of blow that out as a portmanteau, it's interesting that to some degree, this was the whole thing, the reason behind the NBN, right? But as you're talking about it, of course I know about this business, but as you mentioned, I'm kind of thinking, they kind of replicated it's almost NBN other, right? The kind of NBN itself was split off. The government took Telstra's copper away and cable. And then Telstra's gone, oh, no, there's other stuff as well. We'll put that off to the side. I am curious, before we get on with it, mate, just a strategic question for you. I'd be curious your thoughts. There was a utilization question with those assets, right? As you say, you build a tower, costs you X dollars. If you put one tower on it, you earn some money. If you put antennas, you put three on there, one from Optus or Vodafone or whatever. Yes, you earn 2 or 3 times as much money. That makes a whole lot of sense to me, purely financially. But if I think strategically as Telstra, am I not giving away some of that? I'm the fastest network, or at least in people's minds, I'm the fastest. I mean, people's minds is having the best coverage. If I start to say to other people, come and do this, if I'm in the Telstra commercial business, if I'm in that personal and business line, I'm kind of screaming at the CEO saying, dude, this is the thing we have. We charge more than our competitors because we do these things. If you start selling that stuff off, you make some money today. But when I go to the market next time and say to customers, hey, upgrade to Telstra 6G, 7G, 148.5G, because we've got the best one, if we start kind of letting other people encroach on that territory, how do you think about that strategically, mate? Good move to monetize it, or bad move to risk the entire brand promise?
Well, Scott, I think you have really, really laid out the field quite well here. But just to take a step back, right? If you do a double click on the infrastructure business, there are a couple of sub-business underneath it. So you've got the towers business that you highlighted. You've got the fiber, which is, your fiber, the network. And then you also have got the exchanges and ducts and pits. Now, each of those different underlying assets, number one, they've got different regulatory requirements. What do I mean by that? For example, on the ducts and pits, there's a regulatory requirement that as Telstra, if you own ducts and pits, you can't say I own them so nobody else can't use it. Because what that means is that if TPG wants to lay out their fiber, they also have to dig tunnels in the streets of the city. And then if another company, Optus, also wants to lay out their fiber, then they also have to dig. So there's a regulatory angle to it, right? If you own ducts, you have to, by regulation, are forced to lease them out to even your competitors, all right? So there's a regulatory angle to it for some of the assets. Now, for the second group of the assets, I'll talk about fiber, all right? So if you look at fiber, again, if you double click on fiber, there are areas within Australia, let's say within the metropolitan areas, where as Telstra, you don't have a significant competitive advantage because all the other players have got extremely good coverage in those cities. So if you have got fiber within, whether it's Melbourne or Sydney or Brisbane, strategically, from a competitiveness point of view, there is no a strategic reason why you shouldn't even listen to your own competitors, because you don't have a significant competitive advantage. They can simply lay out their own fiber and they can compete with you. And secondly, if you do that, you force your competitors to lay fiber, and that will lead to overcapacity. The reason why is there's some intricate details around fiber. So just to give some stats out there, it costs around $35,000 to lay lay 1 kilometer of fiber, right?
Wow. Okay.
But if you double click on that cost, you find that the actual fiber itself can cost about $3,000 or $4,000. So what is the other $35,000 for? The other $35,000 is digging the ducts and laying out the fiber. Right? So what that means in terms of day-to-day business is that if Telstra doesn't lease its fiber to its competitors and it forces them to dig, now if a company comes and they lay down their fiber, they are not going to lay, let's say, 12 strands of fiber. They are going to lay 1,000 strands, because the marginal cost of laying 12 strands is almost the same as laying 100 strands of fiber. So the end result of all this is you've got overcapacity within the metro areas. And when there's overcapacity, Scott, the next game in town is a prize war.
Yeah, exactly. That's right.
So and then, but besides the cities or the metropolitan areas, Telstra has also significant strategic advantage in the regional areas, in the rural areas. In those areas, yes, it makes sense not to lease your fiber to the competitors, because it's simply so expensive for them to replicate your coverage. So what Telstra does is that within certain geographies, they do lease to their competitors, but in other geographies, they choose not to lease to their competitors. So it's almost like on a case-by-case basis.
Nice one, mate. And I've got to say, I didn't prepare you for that question, but there you go, viewers. Obviously, Trevor knows this business very, very well because he's given a wonderful answer. Mate, let's turn to the now. Telstra results out relatively recently. We're recording this on the 24th of August, 2021. It's important to date stamp all of these because, frankly, things change. This is Telstra as we know it now. We don't know what happens next. Mate, the numbers weren't exactly flash. You said Telstra's not a growth company. Right now, Telstra's a degrowth company or a decline company. I don't know what we call it, but the numbers, they're working really hard. I often say about Qantas. I think Alan Joyce has got one of the hardest jobs in the business world. If he does really, really, really well, the best he can almost do is have Qantas survive. Because if he doesn't do really, really, really well, it goes broke, right? Airline business is really tough. If you're not going to make the squillions of dollars, you're not going to be the CEO of the year with all this massive growth because you're in a really tough industry, and just keeping alive is a good thing. I tend to apply the same thing to Andy Penn, mate. Given the challenges we've just talked about, I kind of figure if he can just keep Telstra afloat, to your point about the dividend at the very beginning, if he can keep that alive, that's almost a victory in itself. Doesn't make it investable necessarily, or maybe it does. We'll ask you that at the end. But someone gets a really tough job. Is he doing a good enough job? Are Telstra's results what you'd expect? What have we seen recently from the company?
So I mean, it's a difficult one to answer, Scott. So in the last 5 years, Telstra has been going through some pains, because like you rightly fully said, they used to make a lot of money on the fixed assets, and since the rollout of the NBN, for the last 5 or 6 or more years, we have seen a consistent headwind in terms of profit margins as Australia as a nation moves from copper cables to fiber cables that are owned by the NBN. So what we have seen is that Telstra has lost quite a significant part of their asset base, right, which is highly lucrative to NBN. So it has been a very, very tough couple of years for Telstra as a business and also for the shareholders. What we saw in the last set of results were a couple of things. Number one is that the NBN is getting towards the end of its rollout phase. I think now they're covering more than 90% or 95%. So the NBN is getting to the end of the rollout phase. So the headwinds that we saw on the operating profit for Telstra, I think they're coming to an end from the NBN rollout. So that's the first thing. So moving forward, so this year, the company reported an operating profit of around $6.7 billion, and they raised the guidance for next year to around 7.5, somewhere there, 7.5 if my numbers are correct, billion dollars. And the reason for the guidance is simply because that headwind from the NBN rollout is really coming to an end. So that's the first thing. The second thing is that as part of their T22 strategy, they have cut approximately 2.6 billion off their cost base, of their operating cost base. So that significant OPEX or operating expenditure cut, we are seeing that benefit flowing into the EBITDA, into the operating profit guidance for next year. But one of the things that really excited the market was that the company managed to sell, or at least enter into a definitive agreement to sell 49% of their shareholding in Telstra TowerCo, which is a subdivision of their infrastructure business. And they managed to sell it at an implied value of around $5.7 billion, which was far much higher than what the market was expecting. The market was expecting it to be sold between $4.5 and $5 billion, but they managed to sell it for 5.7. So the market was really excited about that transaction because it came in, much higher than the top end in terms of estimates. And the company has pledged to retain almost half of that proceeds back to shareholders in form of a share buybacks, and also to use approximately the other half to pay down their debt. So the market was quite excited about that particular transaction. But I think what it really signaled to the market is that the sum of the totals is much higher than Telstra's, the way that the company is being structured at the moment. So then there's a question that there are opportunities for Telstra to unlock more shareholder values, either by selling off some of this shareholding in the fiber business, and also by selling off some of its shareholding in the ducts and pits and exchange business. So I think the market is quite excited about this unbundling, if I can call it, of the company.
I like it, mate. We should at another time talk about that, because there's the conglomerate discounters, as people like to call it, when you kind of add some businesses together. And this is normally not, Telstra's not exactly a conglomerate, right? It's a pretty vertically integrated business. But when you talk about traditionally conglomerates, you put I used to work for Heinz, the food company. At one point, they owned Stanley Wines and a whole lot of other things. I think they owned a fun park at some point. The conglomerate discount, where the market looks across and goes, I don't know how to value this, and it's all a bit of a mess. So we kind of can't value it at full value as if they were separate businesses. On the other hand, I don't know, mate. The market's supposed to be pretty clever and pretty efficient. If you kind of break it up, it's worth more than together. You think, well, hang on, the business hasn't changed, right? Just because you put it in different buckets doesn't mean there's more in the buckets. And yet, as you said, you end up with more like the $5.7 billion implied valuation of TowerCo. So let's talk about that another day. But it's just an interesting point that you would think that if clever analysts could look at this thing separately and then add them together, we should get to the same number, but we rarely do. Let's go to Telstra the business. Let's go to Telstra the investment. And let's talk about both the bull and the bear case. You're a persuasive man. Last time you had me on, I was buying and I was selling. Let's try that again. See if you can get me on both ways. Give me the bull case. I do own some Telstra shares, so make me happy. Explain to me why Telstra might be a buy at today's price.
Well, Scott, I think there are a couple of good things that can come out of at least that the company can really do over the next couple of. I think the first one which is low-hanging fruits, is this continued separation of infrastructure business into a standalone company. We have seen it in Europe. We have seen it in North America. It's quite extensive because the market understands that if a fiber or if a tower is owned by a separate entity, that entity will maximize the use of those assets compared if those assets are held by Telstra in-house. So this separation, I think, is going to continue. I won't be surprised if we see another transaction for the other assets. And one of the most talked about, and hopefully one day it will happen, is that when NBN is finally privatized, as the government has promised, there is a business case that NBN, when they're privatized, that will be merged with the Telstra fiber business. So we hope to see that there will be a lot of synergies and also a lot of I can call it more efficient use of assets if that becomes a separate and standalone business. So that's the first thing. The second thing is that I think we spoke initially that over the last decade, I can probably call it decade, we're seeing downward pressure in terms of average revenue per user, which is how much people pay for their data plans or for their mobile plans, or how much companies pay for their data. What we are seeing at the market at the moment is that downward pressure is almost hit rock bottom. So I think businesses have finally realized that there's only so much that you can do in terms of a price war. So we expect that as ARPU stabilizes, we expect the profit margins, at least for Telstra, to also stabilize. And then looking far ahead into the future, there are also opportunities in terms of edge computing, right? Because telcos, by their very nature, are strategically positioned to take advantage of edge computing. And here what we mean is that we are getting to a situation where the technology, instead of data being processed in the cloud, because of new technology, we expect data to be processed on the edge or on the devices where that data is being generated. And telcos, by their very nature, that they own the exchanges and they own a lot of what we call points of presence, extensive network of points of presence. By their very nature, they are strategically positioned to do well in that space. So I think if management is able to execute on those issues, I think they'll be able to deliver. They'll be able to deliver some good value for shareholders going forward.
Mate, you've done it again. You've convinced me that holding my shareholders is my Telstra shares is a great idea, and I'm excited about the future. Now I'm going to ask you to talk me out of it. Let's go to the other side of the page. Let's go down to the bear case. Convince me, despite my now renewed optimism and renewed enthusiasm, why I should think about selling my Telstra shares. What's the bear case, mate?
Well, Scott, I think the telco, I think you actually managed to describe it quite well. Telco is an extremely tough business, number one, and it's a high capital intensive business. I think Telstra, on average, they have to spend something close to 3 billion each year on their capital expenditure program. So this is a capital heavy business, right?
Just to stand still or even go backwards, right? Like you think about it's been declining for 10 years, and yet it's still spending $3 billion a year for the privilege of going backwards. That's a tough business right there.
That's a tough business, right? And it's really by the nature of the assets that you have to spend in terms of fiber rollout. And now everybody's talking about 5G, right? So the telco companies are under pressure to spend in terms of rolling out the 5G network. But at the moment, the market is struggling on the business case for 5G, as in it's good to have faster internet, which is 100 times faster than 4G, but who is going to pay for it? And we still don't have an application, or we still don't have a business case or use cases to be able to pay for that 5G rollout. So I think that's the first thing. The second thing is that I think Telstra, all right, as a company, it's like you said, it's a 150-year-old probably company, right? And it's not our typical high growth companies. Data consumption is increasing, but also there's so much pressure in terms of data pricing. So the company, this is a typical company where we don't expect to see so much revenue increase. The market is saturated. There's so much competition, and NBN also is actually quite aggressive in terms of its rollout. Most recently, I think over the last 18 months, NBN, at some point, they wanted to move into the enterprise market, all right, and start offering solutions to the enterprise customers. That would have blown all the telcos out of the water. But luckily, NBN have retreated back. But it shows you that it's a market where, as Telstra as a company, you don't have a competitive edge, really, because what you supply, the end product, which is data, is actually a commodity product. And data from Telstra is essentially the same with data from TPG or from Optus. So you don't have a market leverage, and you can't really increase price. So to your point, if you can survive, and if they can maintain the 60 cents dividend, I think that in itself would deserve an applause.
which is saying something, right? Where I don't know, it must be tough to work for Telstra. I think I've been lucky enough in my career to, I think, almost always work for growing businesses of varying degrees. I work for food companies that don't grow fast by their nature, but you set the next year's target as higher than last year, and you go and try and achieve it, and you kind of do that. I kind of imagine that the morale and the culture, it must be a really, really tough thing for Andy Penn and the team there to kind of get people excited about just not declining faster. That's best case, at least it has been, although you pointed out maybe the future gets better. But it just must be really kind of psychologically, mentally, emotionally tough if you kind of want to care about your work, to go to work knowing that you're going to finish the year worse than where you started. As you say, a very creditable result, but still must be kind of culturally tough. All right, so let's bring it to a head, Trevor. Let's you've given a spectacular overview of the business. You've talked about, you've convinced me to buy, now you've convinced me to sell. I'm going to ask you to try and balance that out for me. Give me a considered view, as I know you've already thought about, from here, from today, from this price, given the 16-cent dividend, given everything else that's going on, and maybe even given some growth next year, which would be phenomenal. Can Telstra beat the market from here? Look out 3 to 5 years. Is it a market-beating investment, mate, or is it one best left on the virtual shelf?
That's a tough one, Scott.
Oh, that's a big pause. You make us wait.
That's a tough one. I think at the very best, if Telstra equals the market returns, that will be a very good outcome. I mean, over the last 5 years, even after taking into account dividend payments, I think they've told the market by around 10%. Over the next 5 years, I think at the very best, if they do quite well, is they'll provide returns which are at least on par with the market. I don't see them outperforming the market.
And I've got to say, mate, if you're going to get a market matching result, you might as well buy an ETF, right? Buying one company and hoping to match the market is probably not the safest way of trying to get that result. There you go. You heard it from Trevor's mouth. He's done the work. He knows his stuff. And he said, you know what, Telstra, probably fine for income, potentially, depending on what you're looking for. But if you're looking for a market-beating investment, and that should be most of us, otherwise buy the market, as I said, and go fishing or shopping or go and do something else, Telstra may not be the one for you. And again, just to disclose at the very end, I still do own Telstra shares, despite Trevor's thoughts. I own them largely because of our trading rules. It's a current recommendation of ours, so I can't sell even if I wanted to. And if I was trying to beat the market, I probably would, like Trevor. Mate, thank you very much for spending the time with us. Thank you for the research you did and presenting that case so clearly. Viewers, I hope you've enjoyed Motley Fool Stock in Focus. If you want to follow Trevor on Twitter, are you Trevor Muchedzi, mate? Is that your Twitter handle?
So it's only Trev.
Very good. There you go. So Trevor Muchedzi on Twitter. Go to there. You can follow me at TMF Scott P on Twitter or Insta, the same handle. You can follow the Motley Fool Australia at the same handle on Twitter and Insta. That's at the Motley Fool AU. And of course, if you're on Facebook, jump onto the Motley Fool Australia or Scott Phillips Money is my page. And of course, check out our plenty of podcasts we've got these days. The Motley Fool Money podcast, The Good Oil with Scott Phillips podcast, which is just launched, brand new. So do check that out. And of course, like and subscribe to this video if you wouldn't mind. Hit the notification bell so that the next time Trevor, one of his equally talented fellow analysts, is on one of these videos, you don't miss out on the good stuff. In the meantime, from Trevor and from me, thanks for watching. Fool on.
Full on.